Warren Buffett was on CNBC when he revealed the IBM investment. He said that he had been reading the IBM annual report for 50 years and that the report had come in on a Saturday, but however many weeks prior, and it's something that he read in there struck him differently. Set rules like minimum position sizings that kind of effectively pushed me into the same place anyways, limiting my ability to go after things that, feel like they're above a certain risk hurdle.
All right, folks, welcome to Investing for Beginners podcast. Today, we have a really special show. We have one of my longtime favorites joining us today. We have Alex Morris, who is the founder and analyst at TSOH Investment Research and the author of this fantastic new book, Buffett and Munger Unscripted, which we're going to talk about today, as well as some other stuff. So, Alex, thank you very much for joining us today. We really appreciate you taking the time out of your day to come talk to us.
Yeah, thank you so much for having me. I'm excited for this conversation.
You're welcome. All right. So let's start with a nice softball. Why stocks? Like you could invest in real estate, Bitcoin, commodities, anything. Why do you pick stocks? What about it what's exciting for you about it?
Yeah, I think that hints at the answer. It's something that I'm naturally drawn to. I think maybe not my whole life, but certainly as I got to high school, college type years, I became really interested in business, and that kind of led to an interest in investing. I also stumbled across some good heroes like Warren Buffett and Charlie Munger, people who showed that if you played the game well, that there was an opportunity to do, in my case, hopefully reasonably well, in their case, very well financially as a result of successful investing. So that part of it all certainly had an allure as well. Even now, and I don't know how far back this goes, but as I go out into the world now and I go drive my car down the street, and I just find it curious and fascinating to think about different businesses and what they do and who their competitors are and why they do or do not make money or sufficient return on capital. And that all to me is just really interesting. And obviously that idea doesn't just apply when you're driving down the street. It applies just about everywhere you go or anything you do. So it's a field with plenty of source material to kind of study and learn about. So I've been doing it for coming up on 20 years now, probably. And I feel like I've learned a lot, but I still have plenty left to learn. So it's a game that just continues to be fun.
Yeah, I agree with that. So speaking of resources, you have this fantastic book, well, if I can get it in focus, that you wrote, Buffett and Munger Unscripted. What prompted you to write this?
Yeah, it's along that similar line of thinking. If I go back to when I first started investing, again, call it my college years, mid 2000s or so, one of the first things that I really learned from was one, the Berkshire shareholder letters directly, but also Larry Cunningham's The Essays of Warren Buffett. And it's still very valuable to have the letters in their own right. But his book, in my opinion, did a really great job of making it really digestible and useful in a way that, again, for me was really important. I still have a copy on my bookshelf that I return to at times when looking for a specific example of something. So that having been so influential for me stuck with me for a long time. And when Berkshire announced in 2018 that they were releasing all the old meetings, which were not available for a very long time, they released all the meeting videos back to 1994, which I guess we learned in this year's letter. I guess I think Warren specifically said, I think it's Steve Burke, right? He said Steve Burke was kind of responsible for getting involved with CNBC and making that happen. Once that occurred, I didn't start working on the book then, but I think at that point it kind of hit me that maybe there was something here to do that was in a similar vein to the Cunningham books. It was also a resource that I just wanted to explore myself, right? I wanted to go through all those meetings, and just for the sake of the knowledge that would come with it, it would probably give me a lot of material for articles and other write-ups. So I started going through it in that manner at first. And then after a little bit of time went by, I think I got more serious about like, okay, maybe I should really start doing the book thing. And then once I did that for a little while and I started to get more serious, I eventually went like, okay, I gotta reach out to Berkshire and make sure that this is okay to do this. I don't know if they're going to be comfortable with me quoting them. And to some extent, as I asked then and say in the foreword, there is a certain amount of editing in the book just for the sake of making it readable and somewhat concise. So I had to kind of go, hey, I'm huge fans of yours. Obviously, I'm going to put a lot of time into this project, but I kind of need the flexibility to do it in that manner. And thankfully, they were okay with the project going forward. So yeah, at that point, then it was kind of all hands on deck. Like I need to get it across the finish line now. and that took another couple of years. But thankfully now we're in February 2025, and I don't have plans for an updated edition yet. So I'm good for a little. I'm good for a little while at least.
Maybe another 20 years.
Yes, exactly.
So if there are beginner investors out there who maybe have never been to a meeting or even watched one of those recordings before, what's the biggest impact for you as an investor? What is the most appealing thing? Anything like that you can share with the audience?
Yeah, I mean, obviously it's incredibly broad. I think it's all starts with the basic framework of what investing even is and what does it mean to buy a share of stock. I was listening to a discussion yesterday from another podcast where they basically said, I think it was Josh Brown, he basically said he thinks at some point in the next 5 years or so that a brokerage like Charles Schwab will have the ability to basically, I think it was in reference to sports betting specifically, but his point in saying it was for the next generation, all they think about this then is up, down. It's like, it's crypto, it doesn't matter if it's a stock, it doesn't matter if it's betting on sports, basically. It's just green or red. And the Berkshire materials are a great way to learn why that is a very faulty way to think about what investing is. And it gives you a proper framework for thinking about what the exercise is and, the constraints that are around that, what you need to do as part of being an intelligent investor. So it all builds from there. But I think it starts you in the right place of understanding that when you go out and buy 10 shares of Apple or 10 shares of DraftKings, whatever it may be, you're investing in a business and you're making a statement there about its value in relation to its price. And you start to develop more tools for understanding what you're really saying, and then also how to think about whether or not what you're saying is actually correct or directionally correct.
Yeah, like, is this business going to grow over time? Are they going to continue to outpace competitors?
Yeah.
What
Are they going to
what
exist? Are they
oh,
going to
go ahead.
exist in 10 years?
Are they going to exist in 10 years? Yeah.
Whether or not they're going to exist is a good place to start. So you start running through all those things. And again, obviously, as time goes on, you develop more tools to think about these things. But I always come back to, whenever people ask me about this, I always say, I think it makes the most sense just to start with a retailer, a grocer, something like that, that you can really understand, one, what the value proposition is and what the competitive dynamics are. And the other thing that you can really do that's very helpful is to take this behemoth, a Walmart with 10,000 boxes around the world, and to look at it, the numbers on a single store basis, and to start think about, what does this actually mean that the average Walmart US store has $80 million in annual revenues? What does that number mean? And what's left after they pay for the product and the people who work in the stores? And when we get to that net number, well, then what does that number even mean relative to the cost to go build the next store or whatever it may? So I just think you start to, if you look at a company like that, where you can really understand it from a consumer perspective and the numbers have meaning to you, you can then translate it into kind of a meaningful output, as opposed to if you're looking at something where you just don't really have any sense for kind of what those numbers are or should be.
Yeah. And correct me if I'm wrong, but I think you practice what you preach there, because you've written a bit about discount stores, right?
Yeah. Yeah. And also, you can learn a lesson there about retail being a very competitive business and whether or not discount stores are the best businesses / stocks in the world. But yes, that is something I've written about a lot. But even then, it's really, you're referencing Dollar General and Dollar Tree specifically are two companies that I own. Again, digging in there, you start to realize, okay, what is Dollar General and who are their competitors? That answer has, in broad terms, you can go, okay, their competitors are Target and Walmart and CVS and Walgreens and local mom and pop stores. And then you start to drill down, like, okay, but what does that really mean? Like, really, you pick a store on a map, who are their competitors for the people who live near that store? When you start thinking about it in that lens, it starts to lend insight into, okay, what's the actual competitive environment? What exists here that's advantageous? Is it going to stay that way? How does that get brought into risk? A good example right now with Dollar General, in my opinion, is a lot of their history, their advantage has been geographic to some extent. They had a CEO in the early 2000s who famously said, "We went where they ain't," in reference to Walmart. And that strategy's worked really well for a long time. And they found plenty of holes throughout the country to move into. What's happening now with e-commerce and omni-channel, just basically meaning like people can pick up stuff in the parking lot of Walmart, right? Or drive and pick up in store. How is that changing the competitive dynamics? And these are questions that when you think about an individual answering them versus a Wall Street analyst or something, I think part of what you realize in this game, particularly if you're thinking longer term, and those are the type of questions that matter, is your discrepancy between those other people in terms of knowledge advantages is smaller than you think. Now, if you're talking about betting on what's going to happen next quarter or next month, the knowledge advantage they have, in my opinion, starts to widen pretty significantly, especially if there's data out there that you can't afford. So you just start to think about all these things more, and I think it starts to inform your kind of development as an investor. And this is all the stuff that Buffett and Munger preach, right? And one final thing on this point, going back to Cunningham's book, the first time I read it, I'm sure I got a lot of insight out of it, but there's a lot of things that were above my head. And as time goes on, when you read it again, things hit you that either didn't make sense to you before, or didn't have the meaning to you that they do now. And I'm hopeful and I'm pretty confident that Buffett and Munger Unscripted will be very similar. I think it serves a very wide range of investors and business people, but it also has value to someone who's basically brand new and also to someone who's been doing this for 25 years.
Yeah, and to that point, one of the things that I really liked about the book when I first picked it up, one of the things that really stuck out to me was how you have everything broken down into different topics and different subjects. Makes it a lot easier to try to learn from it if there's a particular area that you're interested in. And as someone who has read through Buffett's shareholder letters twice, I did it once during the pandemic and once more recently, and then tried to look through the transcripts. I was like, oh my God, this is daunting. That's one of the things that I really appreciate about what you've done, is that it makes it so much easier to search through their archives to find things that are relevant to you right now, as opposed to like, oh my God, I got to read all 5,000 pages of this.
Yeah, I appreciate that. I mean, that's really what I was trying to do, right? And that's one of probably the most common pushback I've heard so far, which I can appreciate because I'm one of these crazy Buffett and Munger nuts. But the thing I hear from those people every once in a while is basically, why do I need this book if I've already watched the meetings or have the transcripts or have read the letters? And I think the answer is there's no way you're going to remember everything. And I also think the way that I think you'd find if you pick up the book and read it, that the way it's constructed is probably it's a lot easier to understand the progression of thought on something or the point that's trying to be made if you can see the 4 times they mention it in 10 years right in a row, or a 15-year period right in a row, versus having listened to the 2000 meeting to 2010 and they talked about this thing 4 times. I think people will find that it's a really convenient resource for seeing how those, I mean, a great example is, which we're seeing a bit now with the results at Geico, is the progression of U.S. auto insurance and their competitive position relative to most notably Progressive, and what's happened with telematics, basically this idea of using, I mean, at one point it was something you actually plugged into your car. I think now it's almost always done on your phone. But Progressive found a way to use data from mobile devices to more intelligently underwrite auto insurance. And if you read the book, you'll see that for a long time, again, before there were kind of cell phones in this fashion, to be fair, but it started from a place where Warren really questioned whether or not this is an input that was going to be meaningfully improve the underwriting decision, obviously some adjustment for the cost of that device, right? But he also talks then about all the various ways that they think about underwriting auto insurance, which that alone is fascinating. But you see the progression over time leading up till, as recently as last year or the year before, where they're basically like, hey, we got this wrong effectively, and we've been trying to catch up, and we're at a reasonably sizable disadvantage as a result of not moving earlier. But when you can see that all in one place, it's so much more useful than if you're just scraping together 12 meetings if you watch them over the course of 6 months or something.
Yeah.
So,
How much do you hear Charlie and Warren in your head now after spending all this time with them?
a decent amount. I mean, I still pull up the book. It was so much. I think in total there was, I have it in the intro, I believe it's like 1,700 questions or something like that. And they covered a lot of other things, obviously, like life lessons or life advice and politics and other stuff that I kept out of the book. I mean, not because I didn't want to go into topics that I don't want to discuss, more so just to try to keep it to any reasonable length and to make it really helpful for investors and business people. But yeah, I think in total it was like 1,700 questions, and more, they averaged more than 4.5 hours each or 5 hours each, and there were 31 of them. So yeah, I heard them a lot over the course of a 2 or 3 year period, whatever it was, but it was enjoyable.
I mean, I find it enjoyable. So I guess two questions. Number one, how many meetings have you been to?
That is a good, I've tried to count. I think it's somewhere around 7, but
Okay.
I don't know for sure. I've struggled subsequently to know the actual number. And
Right.
I was writing about it in the book. I just had to eventually say multiple meetings because I couldn't exactly figure out what the number was. But the first time I went was, just a quick backstory. I told you I started basically doing this in college, and I went to the University of Florida in Gainesville, which thankfully is in northern Florida as opposed to southern. But a buddy and I, he was also quite interested in this stuff, we drove from Gainesville to Omaha, which I somewhere on the order of 20 or 25 hours. And we were college kids, so we didn't really have any money. So it was a leave on Thursday morning. I think we did a Walmart parking lot Thursday night, get there Friday. I think my mom was kind enough to get us a hotel Friday. We went to the meeting Saturday, and I think we started driving back Saturday afternoon or something like that. So the first trip was I won't be doing that again. Let's put it that way. But yeah, I think it was somewhere around 7 or 8, I believe.
Okay. What do you have a favorite? Like, is there a shareholder letter or a meeting that you have listened to, read a lot, that you think is really one of their best, or are they all great?
I mean, I think they're all great in certain ways. I would say the earlier years to me struck me as the more impactful ones. And I looked at one point, I believe the 10-year period from, I guess it would be 95 to 04. I think that's right. The 95 to 04 period compared to 2015 to 2024, I think I selected 3 times as many answers from the prior period. Some of it was because they covered ground they already covered before, and to the extent the answer was basically the same or similar enough, I just kept the earliest reference on a given topic. So that's part of it. The other thing is the meetings changed to some extent, particularly with the reporter questions, but even the audience questions too have kind of evolved to a lot more of the political and life advice stuff, or things about Coca-Cola's influence on the world, things that are fine to learn about and interesting, but they didn't have the same kind of tone as really clearly shareholder and people who have thought about a lot about business type of questions. How do you compensate your managers, and how do you think, like, those things? So I'd say that the period during the 1990s to 94 to 99, especially as you get through the tech bubble, .com bubble, through that phase is really interesting because the tone of the questions, particularly in the back half of that period, start to, at each meeting, there'd be a handful of like, what the hell are you guys doing? You're missing out on all this money type of questions. You're missing out on the future, basically. So it was really interesting to watch them navigate that part of it. And then when you get through the period in the, call it 2004 to 2007, 2008, there wasn't a ton of, as I remember it, I mean, it's in the book, of directly commenting on the real estate market. But they do get in discussions about things like, a really prominent one is when they bought Clayton Homes, the manufactured housing business, they talk about how basically the credit cycle in that particular lending market went through a period, and I believe it's early 2000s, 2001 or so, where it put a number of the players out of business, basically, given the funding just dried up. And it's a really interesting precursor to what then happens in the broader residential real estate market. So it's things where you listen to them in hindsight and have the knowledge of obviously what's going to happen, but you're hearing them kind of talk about it beforehand. So those were incredibly interesting too. And then any discussions about, it's pretty rare because I don't think Warren in particular likes to do this too much, but any discussions about specific businesses have always been really interesting. The one that comes to mind for me is when they talked about National Indemnity, which is their insurance business that from the period of, call it 1980 to 2004, a 25-year period, it's a roller coaster in terms of premium volume. And they basically talk about why that happened and, how most companies certainly would not be able to do this, particularly if they're public companies, but how it's really the right way to run this business. But in that example, which I go through in a ton of detail, which I write about in the book, is another one that just really sticks with me as a really insightful discussion.
So, how do you think about, after spending so much time with those two, how do you think about the idea of a circle of competence, and how do you define it, and I guess how would you work on expanding it?
Yeah, it's a really interesting question. I think without speaking for him, after having gone through this, I think I've developed slightly better understanding or a more convicted understanding of how I think about Warren Buffett defining that question, which I think a big part of it is price as like margin of safety and obviously interplaying and with certain circle of competence in a certain way as a big part of it, but then certainty around business economics as a circle of competence, but also, or maybe not certainty, but a level of influence or understanding on that. And then also that same idea applied to capital allocation. I think that's the big kicker. That is something that I understood, but I think I understand more fully now. And I think you actually wrote about it in this year's letter when he talked about Forest River and that the RV manufacturer and that deal. His wording on that specifically hints at what I'm getting at. And that also influences, in my view, how he thinks about, and obviously this influences price as well, right? But how he thinks about growth and whether or not it's something that's actually particularly desirable to him. Because I don't think he's not a huge fan of, I mean, he loves growth when he can invest incremental capital and get a good return on it, right? But I don't think he's a fan at all of growth when that part of the equation is not almost certain, probably because intelligently and correctly he realized he can probably do it himself. Else he doesn't have to reinvest in that particular business, right? So I think that influences a lot of the ways that, from my perspective at least, that I think he kind of views that topic and informs. And you can go look at the companies that Berkshire owns, right? You can make a fair guess on a good number of them that they were relatively well established in the market that they competed in. They were not things that had huge growth prospects outside of significant reinvestment or inorganic activities. And then the price probably was somewhat reflective of those two factors. So that's how I kind of frame how he thinks about it. For me personally, I think it kind of depends in the context of a portfolio, what the circle looks like and how much you're willing to let it expand depending on the nature of a given investment activity, right? And that's kind of a squishy answer, but if you're considering something that's going to be a smaller percentage of the portfolio, if you're taking, how does he think about the Japanese companies that he wrote about this year, where it certainly seems like part of it's a bit of a basket bet, and they're already broadly diversified anyways, it sounds like. My point being, I think he probably thinks about that slightly different than making a large allocation to an individual security. So I don't know, I probably maybe stupidly have a little bit more of a less restrictive view in terms of how I think about accepting risk as part of that equation. But yeah, I still try to obviously stay within my circle. And I have certain rules that I've implemented over time for the sake of pushing the action that I think I want out of the portfolio, which is basically concentrated and longer term. So I've set rules like minimum position sizings that kind of effectively push me into the same place anyways, limiting my ability to go after things that feel like they're above a certain risk hurdle. But yeah, this question of conviction and certainty, again, business outcomes and capital allocation, I think is really probably the main takeaway, at least that I've pulled from it.
You mentioned like a minimum initial size. I don't know if I've heard many people talk about that. I can relate with buying something and being right and being so mad that I didn't buy more or didn't buy enough. So I think that's interesting. What is your minimum initial size and what brought you to that decision?
Yeah, I've set it at 5%. That number is certainly arbitrary. I think there's probably an argument for it to be slightly lower, I think, for the sake of allowing a bit more activity in terms of potential number of holdings when there's opportunities out there, right? It was informed by, I got to a period in, I believe it was 2000 or so, or 2020, sorry, and looked at a portfolio where I had like a growing number of these called like 1% positions. And it just reached a point for me where I was like, if I'm what you just said, Andrew, right? Like, am I really convicted in this bet? And if I am, why am I only making a 1 percentage point allocation to this security. If I'm not willing to make it, again, for now 5, that number might be too high, but if I'm not willing to make it 5% of the portfolio, does it really deserve to be in here? Like, do I really have the conviction to own this thing? And am I owning it, or is this something where I'm effectively trying to trade it? Which it's fair to admit that, but to the extent that you don't want to do that, then you might want to take actions that kind of restrict that type of activity, right? So that's kind of where it came from. But yeah, it's somewhat arbitrary, and like anything in investing, right? This is something I've certainly come to appreciate more. There's trade-offs relative to any other approach. It's not. I'm certainly not saying that is a better way of doing it than someone who doesn't think in that way.
How do you think about the idea? So to get to the conviction to add something at that level, like what does that entail? Like how long are we talking here? If I say, okay, Alex, I want you to invest in, I don't know, Costco, just for example, how long would you have to do air quote work before you'd feel like, okay, I know this enough that I can bet on this?
Yeah, it's pretty rare that I look at something and then it's in the portfolio. Like even if I spend a week or two on it, and obviously depends on if something's like I looked at Brown-Forman recently, the spirits company. Like it's obviously not the hardest thing in the world to understand, but it is a bit outside of things that I've looked at before, and I don't have a great understanding, or at least I didn't beforehand, of who are the major players here, how much of this is domestic versus global, like stuff that you got to kind of figure out. Whereas if you told me to go look at, I guess Whole Foods when it was public, or some U.S. grocer, like I have a lot of background in that space to do that analysis fairly quickly and to get up to speed on it. So that process can take anywhere from a few days to call it maybe 2 weeks. But again, from there afterwards, it's pretty rare that I would invest in something right after that. It usually is a starting point for kind of continued learning going forward. The thing I've been buying most recently has been Dollar Tree, which I didn't own. I've never owned up until, by the way, at TSOH Investment Research, I disclose everything that I do in my portfolio before I do it. So I should say that. I started buying it at some point last year. People can go check when exactly that was. But I followed the company for probably over a decade at this point. But I've had other investments in the space in terms of I own Walmart at one point. I own DG currently. So again, like it's something I've been following for a really long time. In that case, I've been waiting for a long time for them to figure out, maybe without going into too much backstory, what they're going to do with Dollar Tree, which is the banner that they started with, and Family Dollar, which is a completely distinct business from what Dollar Tree is. So long story short, I've been waiting for a long time to see what the actual resolution will be here. Would they basically fix Family Dollar? Would they get rid of it or find some other way to address this issue? Well, now they're trying to go down the road of getting rid of it, basically, or finding an answer for it. And I've been waiting for that basically for a couple of years. There's a way of thinking about investing where you're just like, here's the value of the Dollar Tree banner, here's the value of the Family Dollar banner. If I can buy the thing for less than the value of those two things, that's great. I'm going to buy it. I think in real life, like when you're actually running those businesses and thinking about what happens when you're dealing with a major headache over here, I think it impacts the value of this other piece potentially very significantly. And I think that has happened to some extent at Dollar Tree, which I've written about. So anyways, I waited a long time for that to happen. So a lot of times it'll be like that. I'm waiting for something that I want to understand more clearly. Sometimes, as happened to me so far with Monster, well, less Monster, but really Celsius more so. I've kind of watched it for the last year or so now and developed a decent understanding about it. And it's just one of those businesses that even as it's gotten cheaper, there's something in my head that says like I don't really have the thesis, or to your word earlier, it's not totally clear to me that this is inside the circle of competence yet to the point where I should be betting on this. So it's not really a price question versus there's some other piece I need to kind of have the conviction to make the move here. And sometimes it's not totally clear what that incremental piece necessarily is. Other times it's very clearly something like they need to get their expense structure to a certain level of control that they don't have currently. Peloton's a company that I wrote up recently where I think that's the more applicable question. Like, can they actually get costs to the place where they need to be for this business to be sustaining? So yeah, it's different for every company. but usually I'd say in the typical case, it's probably following it for at least a couple years before it finds its way into the portfolio. But it also helps real quick. It also helps to be able to, when you only need to find 15 stocks, right? That again, like these things are all interrelated. If you're going to have a portfolio where the max position size is 2.5% and you're comfortable initiating a position at 0.5% or 1%, well then, yeah, you're probably not going to be able to wait multiple years before buying a new idea because you got to get something in there. So it's trade-offs and different approaches.
One of the things I've enjoyed about your work, reading some of your Substacks, has been I'm long Microsoft along with you. And I feel like when you talk about that company, you're very objective about portfolio position sizing, how you see the direction of a company, even though you're obviously have a vested interest. For a company like Microsoft, the tech behind cloud can get kind of confusing, right? And that can be hard to feel like you have an expertise there. How did you overcome that personally for that company? And then how do you recommend for investors who are intimidated about tech or other parts of the business where it's like, oh, I haven't spent time in this industry. How could I ever learn enough to make an investment here?
Yeah, well, I appreciate the first comment. I think it's worth highlighting real quick because there's probably a younger version of myself when, someone said something bad about XYZ stock that I own was probably more defensive or getting in little arguments online or whatever it may be. And well, for me, that's not the way to act, nor does it have any influence on anything, by the way, which is probably the more important point. What I say or believe about Microsoft has effectively no bearing on one, how the company is going to do or the stock price. So depending on the type of companies you're talking about, you should feel fairly comfortable being as objective as you need to be. To the second part, I'm reminded of something that, and I've tried to pull this up many times and I can't find it. His name's James Montier. He used to be a research analyst at GMO and a couple other firms, but he told the story one time of, I believe it was in the late 90s, where he worked as an analyst or with an analyst who was like the computer analyst, right? Or he probably followed a company like Microsoft, right? And the guys like claimed the fame that he could take apart a computer and he knew like every single piece in there and where it went, and he could take it apart and put it back together again. And I think kind of the point of what he was saying was that's not really what it means to have that company within your circle of competence or to totally understand what they do. Like, not to say that it's completely irrelevant. It might actually be helpful to potentially know some of these things more intimately. I've never found that that's a huge hurdle on Microsoft, and I definitely don't have, how you framed it is fair, if not generous. I do not have the technical knowledge on a lot of this stuff. What I do think I understand, and what has been somewhat clear to me over time, and then obviously having evidence over time to support this view is obviously also very important, is some understanding of their core franchises, something like Office. What is the purchase decision like for the person who's buying it? What are alternatives? What is the selling mechanism basically? Like, how does Microsoft selling Office compare to somebody else trying to sell a competing productivity suite? And then also over time, how much of the current position of Office is self-reinforcing in terms of them being able to parlay that into other advantages? I mean, what's happened with them and with Zoom and Teams is probably a pretty notable example of how that kind of works, at least in the world of enterprises and probably SMBs as well, right? So I think that's part of what has informed my thinking. Another incredibly important thing at Microsoft, in my view, has been management. I mean, and maybe going back real quick, Microsoft's a company that I've owned since 2011, but also in 2011, I was freshly out of college. So, or I graduated in 2011. So it's not like I made some great, it's turned out to be a good call, but the basis of it was more so a value investing type of, this thing is cheap and Windows and Office have some level of permanence and pricing power that I think makes like a high single digit PE x cash. That's just too cheap. Fast forward a handful of years and they're starting to learn more, and they go through a CEO transition, hire Satya Nadella. I can kind of remember when they had something that was an equivalent of an investor meeting. It was either in late 14 or relatively early 15, where they laid out their commercial cloud targets of getting the business to $20 billion. And it was a the start of a really important turning point in the story. I think when you started tracking the numbers from there and thought about, not to say I did this perfectly, obviously, but started thinking about who they actually service and what their business is, the scale of that opportunity was going to be very, very, very large. Then I'd add on something like Satya Nadella releasing his book Hit Refresh, right? And getting just getting more and more of an understanding of, technically not something I can totally grasp, but I'm smart enough to be able to go, okay, if someone's serving kind of the core computing needs for corporations and small businesses and to some extent individuals, it's going to be a very, very, very large market. I don't know how large with a pinpoint estimate, but I know it's going to be very, very big. And then again, when you read his book and you think about what he says there, you just get the really strong sense that the advantages I've already discussed, when you then mix that with a leader who has a very clear vision and kind of knows where he wants to go and has the financial wherewithal to be able to do so, it just strikes me as a really compelling bet. Now that bet has got more challenging seemingly every quarter, every year subsequently as the price went up and the value investor in me goes, hey, I used to buy this thing at 8 times X cash earnings, and now the number is a lot higher than 8 times. And that has been a learning experience as well. And I really think an important thing there, especially for younger investors, again, is these situations can arise where it starts to consume so much of your time and thinking around a given individual position. And obviously it's becoming a bigger part of the portfolio. Like, I appreciate that. Even myself still at times, you need to kind of step back and think like, okay, in the context of a portfolio, what is the bet? I mean, if the price just seems like it's obviously absurd, then you need to do something about that, right? But not everything has to be so black and white. Decisions can be spaced out in terms of time to some extent. And you got to be able to just calm yourself down and to think about like exactly what you're trying to do. And then the approach that you can take to kind of get there. And I wrote about Netflix recently as an example of where I think this can go awry. I'm sure there's people who, when the company got hit a couple of years ago, when the stock price went down significantly, it was under $200 a share. I'm sure there are certain people who said, I look at my family's usage and my friends' usage of this relative to other streaming services. Like, I'm just confident Netflix is going to be the winner. They're so much bigger. They've proven their pricing power to some extent. As the price then starts moving, there's this question of like, how do you react to that? And I think more often than not, it's the people who are, quote unquote, the smartest, or the people who are like doing the most rigorous financial analysis, who are the ones who get shaken out of a situation where if they step back and you ask them, like, do you think this company has great leaders and has a great long-term opportunity and you want to own this business? Like, they say yes. But then you take an approach to doing things where you're not owning those things as a result of your actions. And again, even this isn't black or white, but it's just important to step back and think about like what your objectives are, and then how do you marry that with decision making or light rules that kind of help you get to where you want to go. In this case, a quick example just to put some context on this would be, I'm not trading every 5 or 10% move in the stock. If it starts as a 10% position, I'm not going to sell 1% every time it goes up 5%. Then when it's up 50%, I'm out. Maybe you trim some every time it's up 25% or something like that. And those rules can be somewhat arbitrary, but some of those decisions are effectively somewhat arbitrary at the extremes. So hopefully that's helpful.
Yes, for sure.
I recommended a stock a couple of years ago that's up pretty big. I want to share that with you so you can see the type of analysis that I do for paid subscribers. Download it for free at stockwriteup.com.
Do you feel like what you do when you're trying to look at a business, like how do you split between the quantitative and qualitative? Like, do you spend more time on numbers, or do you spend more time on not numbers?
I'd say, I generally come with I'll get to that part real quick. I generally come with the exercise in a way I think Warren said previously, like a journalist, right? Just thinking, I kind of walk into the exercise going, okay, I'm looking at Microsoft or I'm looking at Netflix. What is the story of this company from some relevant starting? Let's say in Netflix's case, they're relatively new, right? They've been around 25 years or whatever, a little longer. What is their story from the start to now? And that story is qualitative, but it's also quantitative in terms of okay, how many customers did they have when they were doing the DVD thing? How many do they have today? How many do they have relative to their competitors? Do these numbers matter? Does it matter that Netflix has X number of customers and somebody else has 1/3 as many? Like, does that matter? Why or why not? So then that kind of feeds into the analysis of it all. But I start generally speaking like a journalist telling the story of like this is the Netflix history. Again, to the I try to also make that for the sake of readers as concise as possible and just calling out the stuff that actually matters and that they don't already know, right? But that's a way I start with it. And again, it's as I said before, like the grocery store thing. It's really just developing, even for myself, like a clear understanding of what the business actually is and why or why not certain numbers matter, basically.
Yeah, that was eye-opening for me during the pandemic. I desperately wanted to invest in Visa, but I couldn't figure out how the business worked. And then one day I figured it out and it just all clicked. Is that something that happens to you when you're trying to look at particular companies?
Sometimes, yeah. I mean, yes, I still struggle with certain, like the name that popped in my head is like Roku and the trade desk and thinking about exactly what's going on there. Or, sometimes it can be specific business things or like strategy, like Roku with the Roku channel is still, it's still one for me that's a bit confusing in terms of like totally grasping why they're doing it and how their strategy has changed slightly from what they were doing even 3 years ago. But yes, that happens. It happens to me a lot. And I think sometimes it's digging more and sometimes it's just like I was saying with the book, right? Sometimes you just need to get to a little bit of a different place to see it differently. You guys probably remember when Warren Buffett was on CNBC when he revealed the IBM investment. He said that he had been reading the IBM annual report for 50 years and that the report had come in on a Saturday, however many weeks prior, and it's something that he read in there struck him differently. I don't know how much of that story is puffed up for the sake of it being compelling, but I certainly think there's some truth to that idea. Like sometimes you see something in a slightly different light and it helps you to appreciate it a bit more. I mean, I remember someone said about, not that I think I really underappreciated the business, but I remember someone once said that Costco's business model is effectively giving, he didn't use the word wealthy, but like people who are well off financially, giving them the leash effectively to just go spend money. Like you're buying stuff it's a value, whatever you're buying in this box. So they can walk through there and just throw anything they want in their cart. And it's like when you frame it in that way, it's really interesting to think about their business and their relationship with customers, right? Which just all feeds into renewal rates, sales per box, et cetera. But like how their business is actually quite a bit different from a lot of the people that they, in theory, compete with. So I think stuff like that happens periodically for sure.
So I guess what is one or two things that maybe you learned from the process of putting together the book that maybe you didn't either remember or knew before?
Huh. Well, I mean, one example is what I said before in terms of this question of, which is really applicable to people who are, I'm not buying wholly owned businesses either, but there's a lot to learn from what Warren is saying effectively in this comment about capital allocation and thinking about those decisions. A very prominent example in the book is when Berkshire invested in PetroChina, an oil company, and I believe it was 2003. And Warren walks through very clearly how he thought about the valuation at a very high level, numbers that anybody would grasp. And then he talked about the change in that situation being that the company had explicitly laid out payout targets for a dividend. And it was a substantial enough number to meaningfully change the equation. I believe it was either 40 or 45% of, I believe the metric it was on against was net income. So he just very clearly lays out why that bet went from something that he probably wouldn't touch to something that he then made a fairly reasonably sized position for Berkshire at that point in time. I think there's a lot of parallels between that and then when you read about how he thought about something like Apple or IBM as well, which didn't work out well. But I think the underlying thought process there is very similar. And the takeaway for myself or for anybody else, I think, is to really, really appreciate the importance of, especially if you're going to own something for a long period of time, that combination of intelligent management, strategic decision making, and then them coming to you at the end of the year and going, hey, earnings were $2 per share. By the way, $1.50 is getting plowed back into the business for reinvestment. That can be a great thing. It can be something close to indifferent, and it can be a very bad thing. So trying to learn about that and understand the importance of it is something that, again, like I knew obviously, but something that has shined through in a way to me that with more significance than it did previously. Trying to think of others. That's really the main one that comes to mind.
Okay. I think my last question would be, you've been writing for a while. You wrote this book. How do you feel writing helps or improves your investing?
Well, I am very biased. I am very biased, but I think it has been, I think for me, it's been hugely important to write. And again, it's what I've kind of spoken about here, but that exercise of taking something and putting it down on a piece of paper and looking at these numbers and thinking about what they mean. I mean, sometimes obviously you start with a hypothesis and then you're looking at the numbers to test it. Other times you're kind of going in without preconceived notions and you're just analyzing numbers to see what they mean. But there's something about actually compiling that and writing it. And then I think people don't have to do it for public consumption, but I think there's a lot to be said for, even if it's a one pager or something that you're sending to a friend or someone who has a similar way of thinking to you, where you can say, does this pass the smell test? Is this logical? Where's the hole in my thinking? If you see anything, like, where could this argument be stronger? And I think to the extent you start doing that, you obviously, I have my one buddy, Francisco, who reads basically everything I write before I post it. And, I kind of learn over time as I'm doing my read of a rough draft before I send it to him, go through a paragraph. And I'm like, well, I just said this company is the clear leader in XYZ space, but I provide no justification for why it's the case. And I say they're going to maintain that position, but I also provide no justification for it's like you start to learn, like, am I just saying something here and kind of building false conviction or like false construction around the thesis, or is there actually something here? And the digging on that stuff is where a lot of times you learn things and it may force you to change what the direction of the article is or the post is. But for me, that's been incredibly, incredibly valuable. I'd also, to the extent that people are comfortable with it, especially younger people, I think there's a lot to be said for putting it out publicly. Like, get your feet wet, find somebody that you can send these things to, and be very thoughtful about wasting their or using their time, asking for their time. But get a little practice under your belt, and then find a way to go out. You don't need to charge people. Go set up a Substack where you post something once a month or once every 3 months, where you try to make something that's really concise as possible, and you try to answer a question or look at a company, and allow yourself the flexibility to be honest about the exercise. Like, a lot of people get to the valuation part and then these numbers start flying out the wazoo of stuff that they've seen used in other reports, right? But it's not like, what does it actually mean? Is any of this actually relevant to you? Is it meaningful? And it's a great learning process to go through that. And bringing this back to Warren and Charlie, I think in Warren's letter that came out, I guess, a few weeks ago, he made a comment about never looking at someone's school before hiring them, right? And that's the reality of the world today. Like, if you're young and you show the effort and you're serious about learning and getting better as an investor, and you're trying to find a job, and you're someone like me who went to the University of Florida, and that name doesn't really mean a lot to people outside of football and basketball during a stretch there, but it's pretty good. But it doesn't mean as much anymore, even in that regard. But no, that stuff, if I was hiring anybody, that would be much more material to me than your GPA from whatever school you went to. So you have the opportunity in front of you to do this, and, get started is basically the advice, because you can, I've done it. I know you can do it, basically.
Yeah. What did Nike say? Just do it.
There you go. Just do it.
Let's do it. Alex, this was amazing conversation. I really enjoyed it. I know our listeners will really enjoy it. Where can people find out more about what you're doing, what you got going on, all that kind of stuff? And tell us where we can find the book. And you also have a little surprise about what you're doing with the proceeds from the book as well.
Oh, yes. Well, people can find it about, thanks for having me for one. It's a great conversation. To the extent anybody wants to reach out to me about anything, I'm always, helpful to the extent I can be. You can find my research service, TSOH Investment Research, at thescienceofhitting.com. You can find me on Twitter at TSOH_investing. And you can find the book online at Amazon, Barnes & Noble, some international retailers. I'm hoping we're going to get in Barnes & Noble stores. I'm told that it's largely based on Amazon sales, which as far as I know, have been decent. So it'd be cool to see the book in stores one day. We'll see. And the one kicker is when I wrote to Warren about this project, and I knew it was going to be, the vast majority of the book is quotes from him and Charlie with short introductions and some shout outs to things I've written at TSOH that I think are applicable to certain sections. But when I wrote to him, I basically, as a kicker to try to get his approval, mostly, I said, I'm more than happy to donate half the proceeds of this book to Glide, which is the organization that he supported for, it was over 20 years through the annual charity auction. So again, philanthropy and life advice, not really the focus of the book, but certainly something where, Warren and Charlie have had a big influence on me personally, at least there as well. So I don't know if we'll be able to match. I don't know what he got he was getting over $1 million or a couple $1 million for some of the later lunches. So I don't know if we're gonna be able to match that, but we'll be able to give, we'll all collectively be able to give a little bit of money to a good cause. So happy to be able to do that too.
Yeah, that's awesome. That's awesome. Alex, this was a lot of fun, and we will put all the show notes, all the links and everything in the show notes, and definitely check out the book. It's well worth your time. And Alex's Substack is amazing as well, and he does respond to you on Twitter. So don't feel like he's too big for you to comment. He will write you back. So great guy, and obviously very smart. So again, thank you for joining us today.
Thank you so much, guys. I appreciate it.
You're welcome. All right, with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.